What if the financial system isn't failing because of bad policy, greed, or mismanagement, but because it's structurally set up to leave most people behind? What if the wealthiest 5% continue to accumulate massive gains while ordinary people struggle to pay rent, buy a home, or save for retirement? And what if the real danger isn't economic, but political, with instability quietly simmering beneath the surface, ready to erupt into dramatic change in ways most analysts are ignoring? In a recent podcast conversation, Joe Carlasare dives deep into the mechanics of wealth inequality, the housing crisis, social security, and why Bitcoin may be one of the few tools ordinary people have to protect themselves. If he's right, the opportunities and the risks are bigger than most investors realize, and the decisions we make today could shape financial freedom for decades to come. Hello, everyone, and welcome back to another podcast summary video. In this episode, we break down Joe Carlasare's recent appearance on Coin Stories, a wide-ranging conversation that runs nearly an hour and begins with a deceptively simple observation. Most people think economic conditions are bad because the average person struggles. But in reality, wealth growth has exploded for the top 5% over the last 5 years, creating political and social tensions that are easy to overlook. Joe isn't talking about short-term stock moves or price predictions. He's connecting wealth inequality, politics, housing, generational equity, and financial technology into a single framework that explains why ordinary Americans are increasingly locked out of opportunity, and why Bitcoin could be a hedge for the future. This podcast episode is about 1 hour long, but we've distilled the most important ideas from the conversation for you, so you can understand Joe's arguments without listening to the full episode. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps support the channel and keeps this content coming. Now, let's walk through Joe Carlasare's argument from first principles and why it paints a very different picture of today's economy than most people are willing to admit. Joe begins by challenging a common mistake people make when interpreting the economy, confusing lived hardship with macro weakness. Yes, many households are struggling. Yes, housing feels unattainable and wages feel stretched. But at the same time, the top 5% of earners have experienced an extraordinary expansion in wealth over the past 5 years. Joe points out that this group has captured the majority of asset appreciation since 2018, driven by rising equity markets, real estate, and ownership of productive assets. This concentration doesn't just affect balance sheets, it reshapes power. As wealth consolidates, political influence follows. Joe explains that when a small segment of the population owns a disproportionate share of assets, policy outcomes begin to reflect their interests, whether intentionally or not. This creates a widening cultural and political divide, where economic strength on paper coexists with growing resentment beneath the surface. He warns that markets often underestimate this risk, focusing on earnings and growth while ignoring political fragility. Narrow congressional majorities, unmet expectations, and voter frustration increase the odds of sudden policy shifts, populist movements, or unpredictable leadership. The economy may appear resilient, but Joe argues that political instability, not economic weakness, is the variable most likely to shock the system. From there, Joe turns to what he sees as the true pressure point of the modern economy: housing. Shelter is the largest expense for most households, often consuming more than 30% of income, and far more in high-demand cities. Joe explains that housing shortages in productive regions distort everything downstream: wages, inflation, mobility, and even career choices. Workers aren't asking for higher pay to improve their lifestyles. They're asking just to remain in place. He critiques popular policy proposals, such as banning institutional buyers from purchasing single-family homes, as emotionally appealing but economically insufficient. The core issue, Joe argues, is supply. Builders face incentives to construct high-margin luxury properties, while zoning restrictions, permitting delays, and local resistance choke off affordable development. The result is a market where demand keeps rising, but supply remains frozen. Until that imbalance changes, housing will continue to act as a tax on labor, quietly eroding purchasing power and locking millions out of stability. Joe's point is simple but unsettling. Without fixing housing, no amount of wage growth or stimulus can restore financial balance. Joe then addresses the widening gap between generations, framing it as one of the defining economic tensions of our time. Many older Americans accumulated assets during decades when housing was affordable, education was cheaper, and capital markets steadily expanded. Those tailwinds compounded over time. Meanwhile, younger generations entered adulthood facing record student debt, elevated living costs, and asset prices already far out of reach. Joe notes that national student loan balances now exceed $1.7 trillion, while homeownership for people under 35 has fallen sharply compared to prior generations. This imbalance delays wealth formation, suppresses entrepreneurship, and reshapes life decisions, from family planning to career risk-taking. While not all older Americans are wealthy, the aggregate contrast is impossible to ignore. Joe points out that when younger generations feel excluded from ownership, political ideas once considered extreme begin to sound reasonable. The danger isn't just resentment, it's disengagement. A system that cannot offer a credible path to progress eventually loses legitimacy. The conversation then turns to Social Security, Medicare, and Medicaid, programs Joe describes as mathematically unsustainable in their current form. According to trust fund projections, Social Security faces depletion around 2035, after which benefits would need to be cut by roughly 20 to 25% unless reforms are enacted. Joe emphasizes that this isn't a forecast driven by pessimism, but by demographics. When Social Security was designed, life expectancy was far lower, the worker-to-retiree ratio was much higher, and medical costs were a fraction of today's levels. None of those assumptions still hold. Joe outlines the available solutions. Raising eligibility ages means testing, adjusting benefits, and explains why each option is politically radioactive. The longer reform is delayed, the sharper the adjustment becomes. Younger workers are left contributing to a system that may not fully support them, while policymakers continue to postpone difficult choices. The risk isn't collapse overnight, but gradual erosion, promises quietly shrinking over time. Against that backdrop, Joe introduces Bitcoin not as a miracle solution, but as a tool, a hedge, a way to step partially outside a system increasingly tilted toward asset owners. He's careful to emphasize that Bitcoin is not a shortcut to wealth, especially for those already under financial strain. Instead, it functions as a long-term store of value, with properties unlike traditional assets. Joe points out that many high-net-worth investors still hold zero Bitcoin, despite its growing track record and diversification benefits. Institutional research increasingly shows that even small allocations can reduce portfolio risk over long time horizons. For individuals without access to private equity, prime real estate, or complex financial structures, Bitcoin offers exposure to a scarce, global asset with no centralized issuer. Joe's argument isn't ideological, it's practical. In a system where inflation, asset concentration, and policy risk are structural, optionality matters. Joe then explains why institutional adoption changes the conversation entirely. The launch of spot Bitcoin ETFs, including some of the most successful ETF rollouts in history, signals that Bitcoin is no longer operating on the fringe. These products allow pensions, endowments, and traditional portfolios to gain exposure without custody complexity, accelerating adoption through familiar channels. He notes that institutional Bitcoin holdings have continued to grow even during periods of price consolidation, suggesting conviction rather than speculation. As Bitcoin integrates into brokerage accounts, retirement plans, and wealth management platforms, it becomes harder to ignore and easier to own. Joe stresses that this doesn't undermine Bitcoin's original principles. It expands its reach. The infrastructure being built today lays the groundwork for broader participation tomorrow, quietly reshaping how value is stored and transferred. Despite short-term volatility and macroeconomic uncertainty, Joe remains bullish on Bitcoin as a generational wealth opportunity. He predicts end-of-year 2026 prices around $120,000, with potential highs reaching $157,000, but emphasizes that these figures are secondary to the structural thesis. Joe argues that Bitcoin is not just an investment. It is a reflection of underlying monetary and social dynamics, a hedge against inflation, asset concentration, and systemic risk. He highlights that adoption is accelerating globally. Sovereign nations are exploring Bitcoin reserves, Corporate treasuries are beginning to hold meaningful allocations, and financial platforms are integrating crypto services into traditional accounts, even with drawdowns or sideways markets. Joe stresses that these are normal cycles, not threats to the long-term thesis. The key takeaway is timing versus adoption. Those who buy while adoption is still low stand to benefit disproportionately over the next decade. Joe frames it as both a technological revolution and a social equalizer, a tool that can empower ordinary people in a system dominated by entrenched wealth. He makes it clear that Bitcoin's potential is massive, but understanding its structural role, rather than its short-term price movements, is what separates informed investors from the crowd. Joe closes the conversation with a message that is both simple and profound. Focus on what you can control. He reminds viewers that, despite rising inequality, housing pressures, political uncertainty, and looming fiscal crises, individuals still have tools to protect and grow their wealth. This might mean improving financial literacy, saving consistently, starting small Bitcoin allocations, or strategically investing in assets that offer protection against systemic risks. Joe emphasizes that empowerment comes from action, not despair. While macroeconomic problems may feel overwhelming, student debt, housing shortages, social security concerns, personal agency remains intact. By preparing today, learning, and taking steps within one's control, individuals can position themselves to thrive regardless of structural turbulence. He leaves viewers with a powerful reminder. The financial system may be skewed, inequality may be structural, and adoption curves may be slow, but those who act thoughtfully now will be the ones to benefit the most in the coming decades. The takeaway is clear. Knowledge, strategy, and measured action are the ultimate hedge, even when the world feels stacked against ordinary people.